India's GDP growth is estimated to have slowed sharply to 6.4% in FY25. This is down from 8.2% in FY24. Now, as per the National Statistics Office's first advance estimates, while nominal GDP growth remains stable at 9.7% compared to 9.6% last year. Let's understand what this really means. Nominal GDP growth is GDP growth plus inflation. So the nominal GDP growth coming in as per the advanced estimates at 9.7%, while the real GDP growth continues to be in the slow lane of just 6.4%. It falls short of the 10.5% growth assumption used for FY25 budget. Now, despite this, the government is unlikely to worry about meeting its fiscal deficit target of 4.9% of the GDP due to strong revenue collection and reduced capital expenditure. Now, which are the sectors that did well and which are the sectors that were laggards? First, let's understand why this number of 6.4% when all estimates from the RBI to the Government of India had originally predicted at the start of the year and during the course of the first 6 months that GDP growth in India will be in the range of 6.5% to 7%. RBI in its December announcement had said that GDP growth may slow down to 6.6%, but the numbers that have come in the advance estimates now suggest that the GDP growth is expected to be even slower than RBI's projection of 6.6% down to 6.4%. However, to meet the 6.4%, considering that the Indian economy grew 6.6% in quarter 1 and only 5.4% in quarter 2, averaging out to just 6% of growth for the first half of the year, now entails that cumulatively aggregating for Q3 and Q4, India's GDP will have to grow at 6.8%. So 6.8% aggregate growth for Indian economy for Q3, which is the December ended quarter, and Q4, which is the upcoming March quarter, is going to be the run rate for India to even achieve the 6.4% in growth rate on GDP. Now, what could this mean for you, the consumer, the user, the taxpayer? We have a very special guest joining us. Vivek Kumar, economist at Quantico, joins us this morning. Vivek, good morning. Pleasure having you on Morning Brief at 9 on News9 Live. We know 6.4% is not something that anybody wanted to see as the advanced GDP growth print for this year. But here we are, 6.4%, which is a sharp slowdown from 8.2% the previous year, will indicate a few things. This will indicate that there is going to be perhaps a slowdown in job creation as well. Now, remember, the GDP is calculated on the basis of consumption. It's calculated on the basis of investments made by the government and by the private sector. We know that the government spending and private capex cycle has been slow, and it is also an aggregate of net imports and exports in the country. But 6.4% coming in. Vivek Kumar, I believe, is back with us now. Vivek, 6.4% growth, not great news. What does this mean for consumers? Can we expect fewer jobs to be created?
Thanks for having me on the show. And yes, 6.4% is probably, I would say, in line with market estimates as well as our own internal forecast. It's a tad lower than the RBI's estimate of 6.6%. And marginally lower than the lower end of the government's own estimate of 6.5-7% band. So, in a nutshell, I think the broader message here is that this is going to be a year of two halves. If you break the, I know it kind of sounds a little bit cliched, but you have a data for the first half of the year. The average growth in the first half of the financial year is at 6%. So, which essentially means that, this is the first advanced estimate, the implied growth rate for the second half of the financial year is going to be at 6.7%. So, if one has to take a view from a first half, second half perspective, then one could probably take solace from the fact that second half incrementally the momentum is going to pick up. So 6% in first half will turn into 6.7% in the second half. On an aggregate basis, you'll end up close to 6.4%. So that's the broad message. The other message here is that if you break all these subcomponents of GDP and look at where the increments are going to come from in the second half of the financial year, the increments are largely going to come from government consumption, followed by private consumption demand, and to some extent exports. Surprisingly, there was an expectation that the second half of the financial year, the public spending on capex is going to improve as the government makes an attempt to meet its budgeted target. But that's not showing up in NSO's or the ministry's estimate of the GDP. The first half, second half divide between capex or investments is absolutely flat at 6.4%. So there is no acceleration in second half capex growth, which the NSO has assumed. So this is somewhat puzzling. This is also somewhat, I think, not very comforting, because it kind of then signals that the anticipated recovery that one was hoping for from the private sector in terms of investment, in terms of capex, is probably not going to show up even in the second half of the financial year. And I think, to me, that is the most
To cut you
disappointing
short,
aspect of the
Vivek, I want to
GDP growth.
understand
Yes.
from you, if we don't see government capex spending increasing, which means infrastructure and all the other investments that the government would have otherwise made for us to be in the fast lane of economic growth is not going to come, then where is this growth of an aggregate 6.7% in H2 going to come from? We know that consumption has also been faltering. It's not the brightest story to write home about.
Well, so consumption has actually two shades here, Karthik, I would say. So one is the fact that there is a perceptible degree of moderation, or in fact loss of momentum in case of urban demand. And that is something which is also engineered to some extent from a policy perspective. So all the tightening that we've seen in the last 2 years is now showing up in the form of slowing down of urban consumption. And that tightening has happened through various routes. Monetary policy has tightened, interest rates have gone up, uh, the credit market conditions have tightened. Some of it, again, has been regulatory in nature. Fiscal policy has tightened. So, all the cumulative impact of all this tightening, and last but not the least, is the moderation in wealth effect also is now showing up, especially in the current financial year, is showing up as a loss of momentum in urban consumption demand. On the flip side, the rural demand is showing signs of recovery. Uh, there are enough evidence of state governments, and in fact, even central government now to a very small extent, going up, in fact, increasing their revenue expenditure. And a lot of state governments in the last 2 years, they are handing out cash in terms of their development spending, in terms of their welfare spending. And that, to our sense, is now starting to show up in case of rural demand. It is also getting reflected in some of the proxy indicators like, two-wheeler sales, tractor sales. Some of the FMCG companies which have reported their earnings, they are showing this stark divide between urban demand and rural demand in terms of their volume growth. So consumption is not all out blanket story. It's a two-speed recovery which is happening. One leg is slowing down, the other leg is holding up well. In fact, showing signs of improvement. And the expectation that the Kharif output is now hitting the market, and Rabi sowing is progressing relatively at a satisfactory level. So all this put together will also start to support rural demand in the coming quarters. So from that perspective, we would be actually slightly optimistic on the incremental difference between private consumption demand as a whole and the second half of the year, with all the agri good news coming into the picture, the incremental pictures on total private consumption demand should start looking up.
We have been in a tight monetary policy spot for many years now, Vivek. And I want to understand, what does that mean for the capex cycle of the private sector to kick in? Because unless that happens, jobs are not going to come by. And if you remember, the focus of the government in last year's budget was also jobs, jobs and jobs. Unfortunately, we haven't seen the kind of job creation that we wanted to see. So, a tight monetary policy coupled with a slowdown in growth, what does this mean for people who are, in any case, dealing with inflationary pressure, whether it is chicken prices going up 20% or whether it is auto prices never reducing? So, overall, what does this really mean for consumers? How long before the job market opens up? How long before the inflation story softens, and how long before there is some money available in the hands of the people outside of the sops that the government gives to the underprivileged section of society before the India story begins to shine again?
Yes, it's a valid question, and what we think is that probably the sensitivity of interest rates to capex, especially private capex, is not that high in a country like India, especially considering the fact that monetary policy is not as tight as how it was in the previous regimes. So during the pre-Lehman crisis episodes, the real interest rates in India, as far as benchmarked against the policy repo rate, was positive to the extent of 3 to 4%. Currently, our real interest rates are somewhere close to 2% positive, and so which essentially means that we are lower vis-a-vis our heydays on GDP growth that we saw, and heydays on private investments that we saw in our earlier episode. So that tells us that interest rates, while yes, they do play a role, they are not probably a binding factor for making capex decisions. What is much more important is the policy environment, the certainty of policy environment, both domestic as well as global. And in this context, I think we have reasons to worry because last 2 years we have not only seen an adverse spike in geopolitical uncertainty, we have also seen we are now also entering a very different geo-economic world order, especially with respect to world trade. And when investments are being planned, this sort of uncertainty is something which probably has a much larger bearing than the immediate cost of interest rates. Last, I would say, but not the least, is the fact that no, I think that's probably all about it. It sums up the argument that interest rates are less sensitive to capex than probably policy environment and policy certainty.